Hey, party people, Ben from Pivot here, and today we're talking about how to invest when the share market is crashing. Something that I think is, particularly relevant with what we're seeing at the moment, the conflict in Ukraine, tech wobbles happening in the US, and I think around the world. So, what I'm going to cover is the key things that you should be thinking about to invest in a down market, as well as some investment basics, mistakes to avoid, and things you should be looking out for so that you can get your money working harder for you, but avoid some of those common mistakes and make a bunch of money in the process. So, guys, please don't rush out and make any life-changing decisions off the back of what we cover today. I strongly suggest that you seek out personalized advice before jumping in. If you're making big decisions, you should be doing that anyway. Guys, just as we're going through today, very happy to go a bit off topic and answer any questions that you guys have got. You can pop them into the Q&A in there as well. So, look, I think a lot of people that I talk to realize that investing is something that's important if they want to get their money working harder for them and make money. But it is challenging there, and everyone's situation is unique. But there are three main challenges that I see that hold people back when it comes to making investment decisions and ultimately getting investment results. And these are the three main ones that I see here. The first one is information overload. So it's like there's so much information out there, so many options, hard to know who to listen to and who to trust. The second is people struggle to really find balance between how do they get ahead financially at the rate that they want, but at the same time live a good lifestyle, live the lifestyle that they want today. And the third is, you've probably all heard of FOMO, which is the fear of missing out. And there is a bit of that there, but FOFU is the fear of effing it up, essentially, the fear of making a mistake that is going to cost you a bunch of money. And what happens is that people end up stuck, and often stuck, not stuck doing nothing, but stuck doing the same thing that they've been doing in the past. And what that means is they're missing the opportunity to be getting more out of what they have now. So today we're really focusing in on investing, but there are three things that you need to get right to be a successful investor. Most people that want to invest think that, being successful as an investor is just about choosing good investments, but that's really only half of the battle. What you need to do if you want to achieve any level of money success is to be nailing it with your structure. So making it easy to save and manage your money, have a good strategy where you know where you're headed, you've got clarity on the pathways, you've chosen the very best pathway for you, and that you've got the right solutions or the right investments in place to actually make your money, get you reliable, consistent progress over time, and avoid those setbacks and downsides and those momentum killing mistakes. If any one of those three elements is missing, it ends up dragging down on the others, and it's impossible to get the results that you want. So if you don't have a good structure in place, it's like you're working with a leaky bucket. If you don't have a good strategy in place, you're leaving peace of mind on the table, you're leaving money on the table. You don't have the same level of confidence. And if you don't have the right investments, then you blow up your cash, which is a pretty obvious one. So they're not just steps, they are elements, and you need to get each of them right. I'm going to focus in, as I said, on the solution side of things today, the investments, but I am going to touch on a couple of the other areas to give you a few things to look out for to nail it in those ones as well. So firstly, just in terms of the investment basics, and I thought it'd be an interesting one to start with I suppose you could say COVID impact, post-COVID impact. You could sort of swap out COVID for Russia and tech wobbles and that sort of impact as well. But essentially, we've seen a structural change in the share market, in the business market, and in economies, both in Australia and around the world. Different sectors are performing better. Obviously, tech has been huge focus the last couple of years. Healthcare is another one. And we're seeing less focus on some of those more traditional industries. So we're seeing different businesses that are performing better or worse depending on what segment that they were in. We are seeing a lot of volatility, so a lot of ups and downs. Obviously, we saw a big crash in COVID with a really sharp rebound off the back of that, which was great. I personally enjoyed the upside that came with that bounce back. But since that time, we have seen a bit of volatility, and in particular over the last probably 4 or 5 months, seeing a lot of volatility with the share market had rallied pretty hard. A lot of economies are sort of in a bit of a funny place. And yeah, that's got investors a little bit nervous. And there is probably a bit more economic risk. We're seeing some interesting inflation data coming out around the world, in Australia as well. And there's a bit of mixed messages in the economy, because on one hand, all of the governments want their economies to do well, particularly coming out the back of COVID. They want that recovery to be there. But then we're seeing, unemployment rates are really low, spending is quite high, inflation is high. The governments don't like that. But at the same time, a lot of people have borrowed a lot of money because interest rates have been so low for so long that the government's regulators and reserve banks, they all realize that if they start jacking up interest rates massively, they're going to put a lot of people under some serious pressure. So there's these mixed messages are creating a heightened level of economic risk. We are seeing a lot of artificial money out there that's winding its way out of the economy at the moment, but the government stimulus that has happened over the last little bit, business is still good for a lot of companies doing good business, prices going up, demand is strong as well, partly I think as a result of off the back of the COVID ongoing lockdown that we saw in Australia. Definitely some of the highest savings rates that we've seen for decades in households. So households are a bit more cashed up now than what they were prior to the COVID disruption. And look, the end result is that I think that there's a lot of money to be made, but you've got to be smart with your planning. So I'm going to start talking about investments, but then I'll talk about some of that decision making and planning, so you can know what to look out for there as well. Before I get into it, though, I wanted to start with a bit of an example. And for anyone that's been following our content, you may have seen this one before, but it's a pretty simple one. There are a bunch of numbers, but essentially just talks about saving money and then investing it into the share market. So what I've used is saving $1,000 a month, 12 months in the year, so $12,000 a year. Over a 10-year period, you would have saved a total of $120,000, but then based on a return of 8.7%, which is basically like the 100-year return on the Australian share market. It's actually a little higher at the moment because of the markets have rallied since COVID, essentially. But you put in $120,000, your shares would have gone up a little bit in value. You would have got some dividends on your shares as well. So the $120,000 that you put in to begin with would then be worth about $190,000 if you'd done that 10 years ago. Keep that going for 20 years, you would have put in $240,000, but your portfolio, with the dividends being reinvested and the growth on the value of your shares, your portfolio would now be worth $642,000. So you can see it's getting some pretty serious escalation there. 30 years, you would have put in $360,000, but you now got $1.7 million. So that's like almost 5x on your investment. And keep it going for 40 years, you would have put in $480,000, but your portfolio should be worth about $4.28 million. So you see that a lot of people they overestimate how much they think they should do in the short term, and then get frustrated when they're not getting the results that they want, and they get distracted and get off track and don't follow through on their strategies. But then they underestimate how much can be done over the medium to long term. And guys, this is starting from a base of $0. So people think that you need to have a ton of money to get started investing. That is absolutely not the case. This is starting from $0 in your investment account today and just saving $1,000 month on month. And you can see that you're going to create, 7-figure level of investment portfolio in a pretty short amount of time. So fairly powerful. But look, you can only manage the risk that you understand. And a lot of what stops people from getting started investing, from what stops people pushing harder and investing more consistently, and therefore getting better results, is that they don't understand the risk. So what I wanted to do now is to just unpack the different risks, the things for you to be thinking about and look out for, and also how you can manage those risks. Because some people say that they don't like risk, but ultimately risk is what makes you money. Buying shares has risk attached to it. Buying crypto has risk attached to it. Buying property has risk attached to it. Doing nothing has risk attached to it as well. So the key is figuring out what the right risks are for you. And for everyone that's following along today, some risks just won't be right for you. And that's okay. That's natural. That just means you want to avoid those as much as possible. Other risks, when you understand how you can actually manage them, you say, well, that makes sense. That fits in with the other things that I want to do. I'm comfortable with that. So you want to get those risks that you are comfortable with and get as much of them as is comfortable and jam that into your money strategy, because that is going to mean that you make as much money as possible in the time frame that you've got to invest. So I'll unpack the different risks. Look, the first thing here is growth risk or growth investments versus defensive investments. Now, defensive investments are things like cash and fixed interest or bonds. You can think of it like term deposit, corporate bonds, government bonds, those sorts of things. Those investments plus cash, they're designed to generate you interest income. They're not investments that are really designed to grow in value. You don't put money into a high interest savings account. You don't put $1 into a high interest savings account hoping that dollar is going to magically turn into $2. It's just $1 is always $1. It just generates you interest income. And that's why defensive investments are sometimes called income investments. They're good. They're good because they're stable. And that's why they're called defensive investments, because they're less likely to go backwards. But again, they're not investments that are going to grow over time. So they're better for people that are looking to generate income from their investments and don't need the growth. Whereas when you're younger and you want to actually be building your assets for the future, you probably need the income less, but you want to create the wealth for later. Then the growth investments make a lot of sense because it's what's going to deliver you that growth. So in that category, you've got property investments, so residential property and commercial property. You've got Australian shares and you've got international shares. And with all of those investments, you buy them, you might buy a share for $50 today, or you buy a property for $500,000 today. And you hope that in 5 years' time, 10 years' time, 20 years' time, that investment has grown, which is why they call it a growth investment. You want to, with growth investments, they do grow and can grow over the medium term. You hope that they grow, obviously, over the medium to longer term, which is why you get them in the first place. But they do have more ups and downs as well. So they are more volatile. And that's why on this risk return trade-off graph that you start with defensive investments where the return that you can expect is reasonably low, but the volatility or the ups and downs is also quite low. Whereas the more you move onto the spectrum of growth investments, property, Australian shares, international shares, you should expect more growth over the long term, so long as you choose wisely. And we'll talk a little bit about how you do that. But you are going to get more ups and downs. So the split between your growth investments and your defensive investments is one of the most important decisions that you need to make when you invest. The more defensive investments you have, the more income your portfolio will generate, the less growth it will deliver. The more on the growth side, the more growth you should expect, the potentially less income you'll get, but the more volatility or ups and downs you'll get as well. And I think it ties in neatly with the next point, which is all on your investment timeline. So, when you buy growth investments in particular, shares go up, shares go down, property goes up, property goes down. But you'd expect that over the medium to long term that you should be able to get a positive return as long as you choose good investments. Now, when you do buy growth investments, though, that they generally, like with shares, for example, the suggested investment time frame for share investments is 7 to 10 years or more. And the reason that they say that is because if there is a significant market correction, COVID was a bit of a weird one because it sort of went down and bounced back. But think about like the financial crisis that happened in 2008, that the share market went down and then it stayed down for years into the future. So if you're ever forced to sell in your investments when the market is down, then you're actually going to lose money. Whereas if you're not forced to sell, potentially you can even buy more when the price is lower, then you're set for the recovery. Now, I should call out that just because the suggested investment time frame is 7 to 10 years or more, if the markets are good and markets keep going up, then you can invest into shares for 6 months, 12 months, like no problem. There's no issues there. There's nothing stopping you from selling. You can buy shares today. You can sell. So you could buy shares right now. You could sell them in an hour's time. You could sell them tomorrow, next week, next month, whatever. But it's just that you need to be prepared to not be forced to do that, because that's when you expose yourself to the risk of blowing up, essentially blowing up your money. So that's investment timeline, and something that's quite important to understand. You just want to make sure, final point on this one, you want to make sure with your investment timeline, when you're doing your planning, and I'll talk about the planning sort of decision-making framework that you can use in a sec, but you want to make sure that your investment timeline and the investments that you choose fit with your broader money timeline and how that all fits together as well. Now, not all risk is created equal. There are good risks and there are bad risks, and I suppose good risks and bad risks at different times, and it is a matter of perspective and what your position is. But what I'm really talking about with this one is big company risk versus small company risk. When you invest in a big company, take say Commonwealth Bank, for example, in Australia, they're the second biggest company in the country. They're multi-billion-dollar business. They're backed by they've got a lot of assets, investments, income streams behind them. That investment is still going to go up and down. You are still going to get highs and lows with CBA. If you look at the share price over the last couple of years, we've seen that. But you'd expect that over the medium to long term, that investment goes up. Now, if you contrast Commonwealth Bank to, say, a small technology startup or maybe a small mining company that has less assets behind them, smaller company, it could actually do really well, or it could do really poorly. And oftentimes when you look at how the return goes, it's like it stays flat for a bit, then there's a big spike up or a big spike down or a big spike up and down, and then it goes flat for a bit. And it's like that sort of heart rate monitor. It is much more volatile, as you see here with the small company risk versus the big company risk. And I think the right move at the wrong time is the wrong move. So it really depends on where you're at. Where I see people go wrong, to put it a different way, is that excuse me, where I see people go wrong is that when they're getting started investing, they get all pumped up to get these small, like high potential payoff, but also high potential risk shares in their portfolio. And they have this wild ride and potentially blow up some cash along the way. In my view, when you're building your foundational level of wealth, looking at having more of the big company, what I would consider good risk in this example, in your portfolio, as opposed to the small company risk, is going to put you in a better position for a smoother ride. And particularly if you think about how to invest when the share market is crashing, or when the share market is quite volatile, that the more smaller companies that you've got, especially you think fast forward from here, no one's got a crystal ball, but if there is a bigger downturn in markets and a prolonged share market downturn, the small companies are going to fare most poorly. So it exposes you to an even higher level of risk. So understanding those risks, and that not all risks are made equally, can help you to choose the sorts of investments that you do end up including in your investment portfolio. But it should also go a long way to giving you peace of mind to invest while markets are volatile, because you know that with the big companies, yes, if there's a downturn, that the company is going to do poorly for a bit, but that over the medium to long term, you expect those companies to recover and recover well. Now, diversification or lack of diversification risk is a really important one to understand. And diversification is a really, really powerful risk management strategy. So when you invest in only one company, whether it's a big company or a small company, the returns that you get on that investment or on your overall investment are just the returns that you have on that one particular company. As soon as you put a second investment into your investment portfolio now, the highs of one are being balanced by the lows of the other, and the return that you get is smoother over time. So if you think about Commonwealth Bank and you put it in a portfolio with, say, Wesfarmers, then the highs and lows of the two companies will balance each other out, and the return that you'll get is smoother over time. It's in between the two returns. So that's with two companies. If you put 3, 30, 300 all in a portfolio, the return gets smoother and smoother, and you still are going to have ups and downs. You can't really diversify away the market risk, but it the more investments you have in your portfolio, the less the overall return on your portfolio is dependent on any one particular investment. That means that if one investment shoots the lights out, you are going to get some benefit, but not as much if you are only invested in that one company. But on the flip side, if one company does really poorly or goes bust, you're not going to wear a huge loss in that. And when you get extremely diversified, so like you put 300, 3,000 investments into your portfolio, like an index fund ETF or a highly diversified ETF, you basically end up with just the share market risk overall. And that's what makes you money. And I'll wind into the market itself and how it works. And what I've done here is I've listed out the 10 biggest companies in Australia and their size in terms of their value and their value relative to the overall share market in Australia. So these numbers are a little bit old. I borrowed this graphic from my book that I released a couple of years ago, and it has changed a little bit, especially CSL's now the biggest company in Australia with the COVID sort of focus on healthcare. But essentially, when you look at it like this, like we know that the total value of the 200 largest companies in Australia is $1.67 trillion or thereabouts, or at least it was when I put this together. And we know that the Commonwealth Bank, the value was $199 billion. And therefore, at that point in time, Commonwealth Bank made up 8.93% of the total share market, the ASX 200. Then you've got Westpac, ANZ, NAB, like all of the big companies, and you know their relative size. But so when you're putting together an investment portfolio, if you were to use these exact percentages, you put 8.93% of your money into Commonwealth Bank, you put 6.96% into Westpac, you put 5.62% into ANZ, then the return on your portfolio is going to be exactly the same as the return on the share market. So, and that's what an index fund does essentially. So all an index fund does is it pulls together a bunch of investor money, and then it splits the proportions to be exactly the same. And you know that the return on the ASX 200 index fund, so that's the Australian Stock Exchange 200 largest companies index fund, is going to be the same as the return on the ASX 200, the 200 largest companies in Australia. That's like when you see the news at night and they say the ASX is up by 1% or down by 1%. The corresponding index fund has performed basically exactly the same, with the exception of a very minor, which is essentially insignificant tracking, what they call a tracking error. So index funds are great for a couple of reasons. One, they're, in my view, and it is a matter of, so I suppose, perspective and philosophy, but one, as I see it, that index funds are highly diversified because you've got 200 different investments at least in your fund, and therefore you're ultra diversified. Because these funds are just really tracking the index, all they need is a super smart computer algorithm and a good administration provider, which means the costs of providing those funds are quite low. The alternative, which I'm going to talk about in a sec, is actively managed funds. And that's where you've got like a research house or fund manager or company that's choosing, like saying, we think that these particular companies are going to do better than the others, and therefore we're going to put more money into them. These funds can still be quite diversified, but because nobody's got a crystal ball, then nobody really knows. So it ends up being a little bit more risk in the actively managed funds than the passive counterparts. The other thing with actively managed funds is that there are a lot of costs in active funds because they've got to pay the research house. The fund manager probably drives a Ferrari. Like, they've got these expenses that they need to pay. That's not just some computer algorithm that needs to just track the market overall. So they're understanding active versus passive investments and knowing what's right and what's most comfortable for you is an important decision that you need to make. When we advise clients, we're a big fan of passive funds, for the most part, passive and socially responsible and ethical funds, especially when just building that foundational part of your portfolio, because it does give you highly diversified, low cost funds where you can sleep like a baby at night, knowing that the return that you get is just going to be the return on the share market overall. Um, so I'm going to talk a bit about the different types of investments you can access, but I can see a question here from Kate. I invested in ARK funds and they dropped so much. Should I continue to dollar cost average in or what? Kate, I'm not sure. I'm not super familiar with the ARK funds. So maybe you could just provide me with a little bit more information. I'm not sure if I'm missing out on the acronym there. But what I would say as a general comment is that a lot of funds over the last little bit have dropped a considerable amount because since the start of January, the share markets overall are down. That's just what happens in the market. And the dollar cost averaging, for anyone that's not familiar with this strategy, is that where you just invest, might be $50 a week or $500 a week or whatever that number is, and you invest every single week. And over time, what happens is that you're buying in at different price points. And so your average, they call it dollar cost averaging, because the amount that you pay, the dollar cost ends up averaging out over time. Now, Kate, the reason that dollar cost averaging strategy one of the reasons why that strategy is so popular is because as markets are going up and down, it means that you're buying in. And as I see it, for someone that's dollar cost averaging, as long as you've got good investments, then you should be really almost happy if you're still investing, because you're buying in more when the market is down. So you keep that dollar cost averaging going. And then you're picking up on the upside. Whereas if you stop investing, to put it a different way, if you stop investing when the markets are down and wait for them to come back up, then you're basically buying in at a higher price. So it means that you end up being behind. So I hope that one helps. Alex says ARK is highly risk profile fund. Yeah, I'm not familiar. I might look into that one and see if I can do some digging and put something up on my TikTok after this with a bit of context around it. Another question here that says, are the ETFs same as passive funds? Well, look, that's actually a really great segue into my next point here, which is what the different types of investments are and how you can access the investments that you want. Because I mentioned active investments, passive investments, but you can access either of those in different ways. You can sort of do it through shares. I'll elaborate on that in a sec. You can do it through managed funds. They have active managed funds. They have passive managed funds. You can do it through micro investing apps. And you can do it through ETFs as well. They all have active funds, passive funds. So the first decision, and I've actually got a bit of a game plan here, but the first decision is that you need to go, okay, well, how much am I going to put between my growth investments and my defensive investments? What's my diversification strategy? What's the risk profile? What am I going to use, active or passive funds? Then you go, okay, well, what sort of investment vehicle makes the most sense to access the sort of investments that I want? Now, if you're just investing like micro investing apps, for example, they're generally low cost tech up, essentially good user experience platforms where you can invest like $5 at a time, really easy when you're just getting started, and you can just crank those investments in. They're getting more and more cost effective, which means that you can build a pretty solid portfolio in these micro investing apps and have it being really competitive from an admin perspective and a cost perspective to other options that are out there at the moment as well. But if you're investing, like if you're getting started and you're investing, say, $5 million, which is a big number, obviously, on purpose, but you might choose to use exchange traded funds, because exchange traded funds, or ETFs, they have a bit more control over the tax outcomes, in that with an ETF, you end up owning a tiny little slice of each of the underlying shares that you invest in. So if you use an ASX 200 index ETF, you end up with a tiny little piece of each of the 200 shares. And where the ETFs have tax advantages is that when that part of the share grows in value or even declines, like there's no tax implications until you sell your ETF. which gives you a little bit more control. Whereas with a managed fund, it might have exactly the same investments. You might have an ASX 200 managed fund. What happens is with a managed fund, you send $10,000 to a fund manager and then they get your $10,000 and invest it into shares. And you might do that tomorrow, but then the day after you do that, somebody else withdraws $10,000 and they might have made a big capital gain. That capital gain, because it's a pooled investment, it gets distributed across a bunch of different people. Now, it does get quite technical here, so don't stress if you're not fully following the ins and outs in this. What I would say is that whether you use a managed fund, an ETF, or a micro investing app, or a direct share, the difference is not going to be too much, and unless you're talking about 6 or 7 figures in your portfolio. So you don't need, especially if you're just getting started, you don't need to stress on the difference. When you are getting up into those bigger numbers, then you want to scrutinize that more closely. Or if you're saving really, really strongly, then it makes sense to have the right strategy from the from the start, so that you know that you're getting the right results, or you're not going to have to restructure things later and wear some unintended consequences as a result. The ways that you can invest. So how you make it happen is you can use stockbrokers. So that's where it's pretty old school. You go to the big tall building with the mahogany desks and you talk to the stockbroker. They're generally going to give you some recommendations, tell you about some company. Normally stockbrokers are like they're sort of a way of normally actively investing, whereby they're saying, we think that this sort of setup for the portfolio, they're making some active choices. We think it's going to perform better. Then you can use online brokers like CommSec, E-Trade, Self-Wealth, etc., where you open up an account and you bypass the stockbroker and you just drive the trades yourself through the tech. Then you can use micro investing apps, things like Raise, StockSpot, Stocklight. There's a bunch of different ones out there. Stake, Goodmans. There's a ton. They're generally quite good in that easy user experience, generally pretty tech enabled, meaning that you don't have to muck around too much with complicated forms and paperwork and that sort of stuff. Particularly helpful given that Officeworks is still out of printers. And you can go to the bank. You could walk up to the bank and you could tell them that you want to invest and buy something over the counter. I'd probably advise against that option in the majority of cases, unless you've got like a private banker and a good relationship with your bank already. You're probably going to be paying overs for whatever they would sell you over the counter, but it is an option. And you can use a financial advisor as well that can help you set up an investment account in your name and then invest in that way. Now, the reason that obviously we're financial advisors, the reason that I included that on this list is to say that you don't need a financial advisor to invest or to open an investment account. You can do it a bunch of different ways, but where a financial advisor can help you is around the strategy and the planning. And I'll talk a bit more about that when I get into the planning piece as well. Now, what I would say when you invest, that I mentioned like at the start, we go, okay, growth versus defensive investments, particularly important, current climate, crashing market, whatever. Then you go, okay, well, diversification strategy, active versus passive. What is my sort of account? Am I going to use ETFs? Am I going to use managed funds? Am I going to use micro investing? But beyond that, you want to make sure that things are structured from as optimal a tax perspective as you possibly can, because for individuals that aren't self-employed or that don't run their own business, how you invest is the biggest area that can save or cost you tax. So your tax planning is really critical here. You've got, in Australia, we work under this marginal tax rate system where the first $18,000 of income we earn is tax-free. Then 18,000 to 45,000 taxed at 19%, 45 to 120,000 taxed at 34.5%, 120,000 to 180,000 taxed at 39%, and 180,000 plus is taxed at 47%. What that means, well, you only get one tax rate when you invest. So one tax rate for your employment income, for your sole trader contract income. You only one for your rental income, your interest income on your bank accounts, your dividend income from your share portfolio. So when you do your tax return at the end of the year, the ATO adds up all of your income together. And then if you've earned 80 grand from salary and 20 grand from investment income, they just say you've earned $100,000. You need to pay taxes if you've earned $100,000. So if you earn more than $45,000 a year from sources other than your investments, your tax rate is 34.5%, which means that for every dollar of investment income that you earn, you're going to get taxed at 34.5%. If you earn more than $120,000 from other sources, every dollar of investment income that you earn, you're going to pay 39% in tax. $180,000 plus, you're going to pay 47 cents in every dollar of investment income that you earn to tax. So these are big numbers. At least a third, up to potentially close to a half of your investment income is going to go in tax. So it's important to be smart. Now, when you invest, you can invest in different entities. So, and what I mean by this is tax entities. You can invest in different tax file numbers. So you can invest in your personal name, and then your investment income is going to be, your investment is going to be owned by you personally. Your investment income is going to be taxed at your marginal tax rate. If you invest, you could also invest in your super fund, and the maximum tax rate that you pay on super is 15%. 10% on capital gains if the investments are held for longer than 12 months. So super is significantly lower than your marginal tax rate. You have to obviously be careful with super, because super you can't access till you're quite old. So I'm not saying that you should rush out and put everything in super, but I wanted to call out and highlight the fact that it is an option, and it's an option that has a considerably lower rate of tax attached to it. One thing I forgot to mention, actually, when it comes to personal tax rates, is that for couples in particular, being smart about whose name you're investing under can make a big difference in the return. So if you've got a couple and one person is primary carer to some kids and potentially working less, earning less income, or it's not a kid thing and you've just got one person that's on a higher income than the other, then you can be strategic and have it potentially own investments in the person that owns a lower income, and then they're going to pay less tax. So being smart there, even just within your personal name, is something that you should be looking to do. You can also invest through a private proprietary limited company, i.e. you just go and start your own company, costs like $500, and then you can open a CommSec account in there and start investing through that. With a company, the maximum rate of tax that you pay is 30%, which you see, and I've got an example here that you see with that. If your investment income is significant and your tax rate is already high from other sources, that can save you a huge amount of tax. And then with a trust, what a trust does is it allows you to distribute income to other sources, meaning that you can pay tax at whatever the rate is of the end source. Individuals, your cousin that maybe is on a lower income, partner, adult children. For minor children, it's actually less lucrative now, but it used to be. So it can allow you to split income, which can be quite helpful as well. You only get one tax rate, as I mentioned. So the tax structures end up being more valuable the more money that you make personally and the more money that you make on your investments. So I just wanted to show you this example, and I want to call out this is absolutely not for everybody, but investing under an investment company versus investing under your marginal tax rate. So $100,000 of investment income, if your aim is to build up passive income of, this $8,333 per month, so that you can be financially free or whatever, if you're on a high income and you're paying tax at the top marginal tax rate of 47%, you're going to pay $47,000 in tax. Whereas a company is only going to pay tax at 30% or $30,000. So the tax saving there is $17,000 per annum. So every single year, $17,000 extra dollars that can grow your investment portfolio faster. This is particularly valid for people where you've got a high taxable income already and you're looking to crank a solid investment portfolio over time. You can see we're talking about tens of thousands of dollars potentially every year in tax savings. And then I've escalated this up to go $200,000, $300,000, $400,000 of assessable income. The tax savings, $34,000 a year, $51,000 a year, $68,000 each and every single year in tax savings. So as I say, not for everybody, but can be significant for the right people in the right circumstances. So a couple of other questions. Rob says, what are your thoughts on stablecoin staking as an investment, high risk or low risk? I would say that's extremely high risk, Rob, depending on, there's a lot of sort of differences with the options out there around that. And I'm not an expert when it comes to crypto staking, but I do know from talking to a bunch of crypto experts that there are some pretty serious risks, particularly around the algorithmic stable coins, and you can end up sold out of positions automatically with no warning and lose a bunch of money as a result. Another question says, is 50K decent to store mostly across ETFs with passive funds? Should one consider into active funds within ETFs? Do trading platforms like Self-Wealth show active passive funds within ETFs? So there's a couple of questions there, but most passive funds are referred to as index funds or something to do with index, or like you'll see a 100. So like it might be ASX 100 or something like that. So you should be able to tell. Basically, everything else is actively managed. Any fund where it looks like you've got an investment manager that's making an active choice around the investments and not just investing into the market average is an active fund. You could always ask the question through, most channels will have some support there as well. So you could do that if it's really unclear, or do a little bit of research as well. I would say at $50,000, depending on how much you're investing, you're probably still in that process of building your foundations, and you probably want to maybe look at sticking more to the more blue chip type investments. Now, that being said, if you're particularly interested in investments or passionate about it, or you're dedicated, you got a lot of time that you want to spend on stuff, then you maybe put a smaller amount into those investments. It can help educate you and build your knowledge as you're keeping an eye on the market. So I hope that one helps. Is that investment income apart from job income? Yes, yes, I believe it is. That's in, if you're talking about the current example, yes. Does one need a director ID with investment company setup? Well, yeah, actually, I just got an email from my accountant about director IDs. So that's a new thing. But yes, I believe if you're registered as a director with ASIC, that you need a director ID. Please don't rely on me for that. You should check with ASIC. Del Fuego says, I like it. How do you avoid being taxed twice? Taking personal income and then transferring it to your investment company? Well, when you make a capital contribution to a company, it's not considered an assessable income of that company. So if you had $1 million in your bank account and you put $1 million into a proprietary limited company, that's not a taxable event for the company because it's an injection of capital. So it's definitely not taxed twice. But that's a very good question, Del. Cool. So guys, putting that into action, what you need to do, understand investing. The growth versus defensive is the thing that I mentioned. Diversification, your active versus passive strategy. And then it's about just getting started and being consistent, optimizing for tax, debt recycling, trust, being strategic. And I'll talk about planning and decision-making in a sec, and understand where property fits. And look, today I'm talking a lot about share investments, but I think property is also great. Property does tend to win. I actually just did some content on this on my TikTok, if you want to check it out. But why property wins over shares, where the gearing part of property investing means that if you got 100 grand, you could just put $100,000 into shares, but you could also put $100,000 into a $500,000 property, and then you got this big asset that's working for you. So while share investing is great, and I think it's important for every person, like anyone that wants to be really wealthy should have some level of shares, then property is also a really important and powerful way that you can grow your assets over time. So, look, I'm going to talk about planning next and show you the process that you can use to plan. Look, essentially, this is the decision making and how it works. So the first thing is to focus in on what's actually important to you. What does success look like? Is there any specific targets or goals or outcomes that you have in mind? The question that I like to ask people to tease this out is to say, hey, if we're having a conversation in 3 years' time, where do you want to be really stoked with the progress that you're making, where things are at, and how everything is going? From there, you just want to actually make some decisions and set up a plan. You need to clarify what money's coming in, what money's going out, where's it going, what cash have you got to work with, what share investments already, ETFs, managed funds, superannuation, what fees are you paying, how's it set up? And then from there, you can look at the strategy and go, okay, well, if I went all in on shares, this is what it looks like. If I decided to buy a property instead, this is what it looks like. Pay down some debt, there's a bunch of different ways you can do that. Each of those strategies are going to have different financial benefits and outcomes attached to them, and they're going to feel different for you. So most people are going to be more drawn to one particular pathway or strategy that they feel gives them the best balance between the numbers and what's not in the numbers. From there, you just want to put it together, action plan, so you know what you're doing now and what's coming up. Then automate as much as you possibly can so you can set your default to success and just make it easier to get the results that you want. And then execute and refine your strategy over time. Unfortunately, there's no such thing as a set and forget money strategy these days because everything's changing so quickly. And what we're seeing at the moment in markets is really a testament to that. You need to be on the front foot so that you can keep having the confidence to follow through on your strategy to ultimately get the results that you want. The impact of from a COVID and disrupted market perspective, you want to be planning fast. Even if you decide not to do anything, knowing that you've got a plan is going to eliminate a lot of that money stress or anxiety. Cash is a bit more risky in the current market, and bonds and defensive investments more risky as well, with interest rates low but on the rise. And you want to play a solid defensive strategy when there is the higher levels of economic risk out there at the moment. I'm going to talk through some of the myths and mistakes that I see and that you should be looking out for. So the first one is that you need an advisor to invest. I sort of touched on that before. You do not need a financial advisor or a stockbroker or an investment advisor to set up an ETF portfolio. You can just go open an account and invest yourself. Where an advisor or a professional can help is in the strategy, being smart with your tax, shaping up the actual investments that you choose, giving you the confidence to do that and seeing how that fits in with your broader financial plan. You don't need to shoot the lights out with every investment. It's really natural with our psychology that when we invest, you want to nail it. You see this potential upside, you get excited because you think you're going to make all this money. And as a result, you end up targeting and facing a higher level of return than what you otherwise might. So, or might want to or need to. Like you see from that previous example that I sent, it just saving and investing, $1,000 a month into the boring old share market average is going to make you a multimillionaire over the time period that's there. So do you need to pick the next Afterpay to be wealthy? Absolutely not. Following the market is going to give you solid returns. Like I said, peace of mind, give you almost a guarantee that nothing is guaranteed, but so long as capitalism continues to reign and that good companies keep making good money, the share market will continue to perform and your portfolio will perform along with it. Whereas when you're picking investments or making even educated bets, then it's not the same. You're not facing the same level of risk. Shiny brochures do not equal good returns. And when I say shiny brochures, I mean the digital ones, slick websites. There's a lot of companies out there that have really solid marketing, but not a lot of substance behind the scenes. So be aware of that. Scratch the surface and dig into the detail to make sure that you're getting a solid investment or a solid solution behind the shiny website wrapper. In Australia, one thing that's actually really important to be aware of is that your investment risk only really sits with the actual investments that you choose. So which ETF or which managed fund or which option within your micro investing app or which share you choose, that's the only way that you can lose money. It doesn't matter which micro investing platform you use or which share trading platform you use or which ETF provider that you use. So long as the provider has a product disclosure statement and a financial services guide. If they have those things in place, it means that you're protected under the APRA regulation, so the Australian Prudential Regulatory Authority. They oversee all financial markets and they're very concerned with making sure that investors don't lose money. So whether you invest, if you're buying shares with E-Trade or Self-Wealth or CommSec, if anyone or all of those companies went bust tomorrow, the investors would not lose any money at all because they don't even hold their shares. They're held by what's called a custodian, which is a third-party company holding the shares to make sure that they're nice and safe. So in Australia, sometimes people go, oh yeah, I'd like this tech play, but is that too risky because it's a new company and it doesn't have that track record? If that's the actual platform, you don't need to worry about it. For the actual investment manager, then track record, in my view, is something that you should absolutely be looking at, but it's all the risk sits with the investment manager. I hope that makes sense. Investing mistakes that people make, making choices in isolation is a big thing. So looking at, oh, I'm looking at this investment. Is this a good investment? I get that question all the time. What you should be thinking about is this a good investment for me? And that means that it needs to be a good investment for you today, as well as a month from now, 6 months from now, and down the line. And how you figure that out is making sure that it fits in with your broader money plans and what you want to be doing from a financial perspective. So if things are changing in your situation in the near future, you go, okay, well, is it going to fit then? And if it doesn't, then it's the wrong investment. And if it does, then you're no longer making choices in isolation. Seeking the very best option. This often comes from our engineer contacts, where they're analyzing, looking at dividend yields or property returns and all of these things. That we never know what the best is until after it's happened. So don't get paralyzed trying to figure out this best thing that we'll never actually know about anyway until a year from now or 5 years from now. Sometimes picking something that's good, taking action and getting results now is going to be much better than this magical best thing that we never actually know about. Set and forget. I've touched on this before, that there is no set and forget money strategy because everything's changing so quickly. What you want is changing. What's going on with your money is changing. What's going on in the world and financial markets is changing. So when any one of those three things changes in a way that's inconsistent with the decisions that you've made, you need to update your decision. You need to go through that decision-making process again. Going it alone is another one that it can be really hard. We fall victim to our psychology. I really geek out on this stuff, that there's a lot of psychology that impacts the investment decisions that we make. You want to try and avoid that if you want to make good decisions. It means that also, though, when you're trying to do it all your own, you're not taking advantage of opportunities. We saw this a lot through COVID, that we had a number of clients that we were in a strong position to take good advantage of the market conditions at that time and make a bunch of money in that process. And they were all very scared to pull the trigger. It was only because I think every single one, even the ones that end up making the most money out of our clients, they were hesitant to go as hard as we had suggested that they do at that time. But they did it anyway. Well, they did it anyway, or they did it a little bit slower and still made a pile of money. And they all wish that they pushed a little bit harder. There is absolutely no way they would have done that without having the support behind them, because you're making big decisions and it's really scary, especially when everyone's talking about the world ending. So that happens at different points. COVID is obviously an extreme example, but it happens at different points in your life, your financial journey, that having people to push you when you need to is going to be really helpful. And you've got less confidence to be aggressive when you need to. Advice within gender, that's another thing as well. So getting there's so much noise out there online in particular, that if someone's got it, if they're selling a product, it's going to be hard for you to build the same level of confidence than you would with someone that's just motivated by making sure that you're making the right decisions. That's why, like for us, and obviously we're biased that we think that our way of doing things is the best way, which is why we do it that way. But we charge our clients fee for service, where we say it's X dollars if you want us to help. Then it doesn't matter if you buy shares, buy a property, save in cash, pay down debt, crank your super, whatever. No one's getting paid anymore. That then gives you the peace of mind that there's no motivation that whoever's helping you is saying you should do this and then they're going to get paid more as a result. There's a lot of different ways to be right here, but that's our take on it. And whether it's financial advice or investment advice or information that you're getting online from research, it's all the same. That try to avoid that agenda or get someone that's a little bit more impartial to help give you the confidence to pull the trigger, because it's about taking action to lead to results. So guys, look, in terms of next steps, I'm just going to share this model with you. It talks about your progression from where you are today to future state. It essentially says that in the future, you're going to be in one of four positions, ranging from not so good to really good. When people think about getting from where they are to where they want to be, though, they think about their progression like a straight line. But because of the compounding impact of time and money, it's actually a curve. So if where you are right now means that you're not 100% on track to end up exactly where you want to be with your money, it means you need to do some stuff. You need to jump the line. So once you do, you need, optimize from a tax perspective, get started with your investment strategy, put that budget in place, etc. Then you just follow the bouncing ball. But the longer you leave it, the more time goes on, the jumping the line gets harder. So no matter where you want to get to, the easiest time to make that happen is right now. The longer you leave it, the harder you have to push. So, guys, look, I hope you found that helpful. I'm just going to, obviously, this is what we do. So, for anyone that wants to chat about, get a bit of a push in the right direction, I've popped into the chat box here a link to our online calendar where you can book a 10-minute phone call where we have a quick chat about where you're at, what the opportunities are, and what your next steps are, and how you could get started. If you want to have a chat, very happy. If we can help, we can talk about how. If we can't, then we can push you in the right direction. Otherwise, we've got a ton of events coming up over the next little while on everything from crypto, property buying, money hacks, mindset, a whole bunch of things. You can check that out just look up Pivot Wealth Ben Nash Eventbrite. You'll see those there. And yeah, feel free to get around that. There's also a heap of content on the Pivot Wealth website. So, guys, I hope you found that helpful. I will catch you next time. Any questions, feel free to hit us up through the Pivot Wealth website as well. Cheers, team. Bye for now.